fears of a recession are rising. Let's take a look at how these assets will perform or will likely to perform in a possible economic contraction. We'll be examining gold, silver, oil, and the S&P 500 as a proxy for equities. Joining us to discuss this and inflation and much more is Bill Baruch, expert trader. He is the president of Blue Line Futures. Welcome back, Bill.
Thanks for having me on. It's always a pleasure to join you.
All right, let's talk about the big picture first, and we'll drill down to the assets we mentioned. Inflation numbers coming out this week. What are you expecting?
Well, we have the CPI coming out Friday, and it's not the Fed's preferred inflation indicator, but it's certainly the one that everybody's watching. The core number, which excludes food and energy, and right now, obviously, the food and energy are the big volatile rising components. But the core number is what everybody watches, what the Fed watches most closely. Expectations are at 5.9%, which means it comes down a little bit. This is a May number, comes down a little bit from the April 6.2. And this is what we've been expecting. We've been expecting sort of what the Fed has done, the hiking, the tightening, the rhetoric they're using, and then the fact that the war in Ukraine had started in February through March, and some of these price shocks are starting to work through the system. Demand is coming in a little bit. I think the last component really that could be a laggard is China. The supply chain bottlenecks that are still working through the system, but China reopening should be, it should be almost a two-sided effect, a little bit of reflation from there, but also ease these bottlenecks. Okay, Bill.
You have a morning newsletter. You've been running with this theme. It's called Inflation Showdown at Jackson Hole, and you discussed with me briefly offline about how you think the inflection point for inflation has not yet come. It's going to come later this summer. Can you tell us about that?
Absolutely. Just as I was talking about, you had the Fed working prices lower and demand sort of deteriorating, and it's going to work through the system. So we had this big move in inflation early part of the year through quarter one, the war in Ukraine as well. And what we're seeing now is the Fed has acted. So April and May were never meant to be an inflection point for inflation. It's good that it's coming down and it's expected to come down. But the inflection point, the real numbers that really matter for inflation in the Fed's path in the second half of the year are going to be those for June, July, and August that come out in July, August, and September. Now, the Fed is expected already to hike another 50 basis points in June and 50 basis points in July. And the inflation numbers, the core CPI in quarter one, the base comparisons for 2021 in quarter one were 1.4%. So, of course, we had these shockingly high numbers. The base comparisons for June, July, and August average of 4.3% in 2021. So we have higher base comparisons. We have the Fed going to work and bringing prices down. Can inflation actually come down? If they can actually come down through the data in June and July and August, then we could get that September pause. The Fed may not need a hike in September and let everything work through the system. So that's how I'm looking at it. I do expect it to come down. I'm positioning with my clients on the futures trading side, wealth management side, for this to come in. It's just a matter of what does the data tell us. However, if it doesn't come in, this is that inflation showdown in August, because we'll have numbers for the CPI in July for June and in August ahead of Jackson Hole for July. If it doesn't, we could see a very hawkish move from Fed Chair Powell at Jackson Hole at the end of August. And you better prepare for that. And I certainly would.
Okay, I'm going to come back. Better prepare for that. How?
Well, if inflation doesn't cool through the data that we see in July or June or August for July, if we don't see that inflation start to cool, markets are going to be reacting. I mean, but don't get me wrong. This number on Friday, if it comes in core CPI at 6.5% and month over month rises at 0.7, you're going to see markets react. You can see the NASDAQ drop 200 points in the split of a second. But does it stay down there? What's the rhetoric? The Fed can walk it back because it was never supposed to be an inflection point for inflation in April and May's data. It's the June through August. If it doesn't cool through those months, the Fed's going to have no choice and become very hawkish. So you want to start protecting your downside, preparing for that, and what assets that would either capitalize, what assets would deteriorate pretty quickly if the Fed had to get more hawkish for the second half of the year.
Let's talk about inflation itself. You know what I'm wondering, Bill? Let's suppose you're right, and let's suppose your prediction comes true in the sense that the inflection point of inflation does come later in the summer, and we will get a pullback in assets or CPI, asset prices or CPI. It takes some time for Fed monetary policy to trickle through the economy. I'm thinking if it comes through, the inflation comes down by July, which really, I mean, that's 1 month from now, Bill. I mean, that's not in the future. That's like coming up. I'm thinking that's coming down because of other reasons besides the Fed. Because keep in mind, the Fed just started raising interest rates not too long ago. It's not like we had a year and a half of lag, right? So what other things besides the Federal Reserve, if you had to speculate, will be causing a slowdown in inflation, Bill?
Well, absolutely the consumer. I mean, the consumer's feeling the impact right now. They're feeling the impact of gas prices. They're feeling the impact of food prices. And again, food and energy are not showing up in that core number, but they trickle through. Everything in the world runs on energy. Everything in the world runs on petroleum. I mean, everything from the lip gloss that people buy, or or the plastic and something that you use at home, it all comes from petroleum. So that's something you really have to understand. So there could be another wave of inflation that starts up later this year or the early part of next year, and especially with the winter when having to heat your homes. But what I'm looking at is this pocket of time where the consumer's deteriorated a little bit. Housing prices have started to come in a little bit. And remember, mortgage rates were the first thing to really react. When the Fed started to get a little more hawkish in November of last year, mortgage rates started to move up. And so that we've seen some of this start trickling through the market. The Fed has already hiked 75 basis points. The market is already acting as if they've hiked another 50 basis points already. So a lot of this is already expected working through the system. And that July number would be the second one that we would get in that chain, and that comes out in August. So there is a little bit of time. And the way I'm viewing it from an equity standpoint, how I'm positioning in stocks for clients, not only on the future side but also on the wealth management side, is I think people are under positioned. People are off sides. People are extremely negative right now. Sentiment's extremely negative right now, and portfolio managers are under position. For us, we've been hedged all year. We took our hedges off and we had some very constructive technical groundwork above 3,800, above 20%, right at 20% rundown on the SP in the year. So we've gotten bullish. We've given ourselves the opportunity to get bullish here, give the market a chance to run, because people are off sides. If this inflation cools, we'll see the S&P, run up to 4,200, 4,300 after this number tomorrow, if it does. And then we move into that showdown where if it actually is cooling in those months that matter, we get another 10% move higher in the S&P, and guess where that puts us? Right near the record highs.
Right. Okay. Record highs. Well, let's follow up on that as the summer months progress. Bill, let's talk about the economic growth forecast that the Atlanta Fed has put out. Now, the Atlanta Fed does track the GDP in what they call the GDP Now model. It's not their official forecast; it's an estimate, and their most recent accurate is 0.9% growth in GDP in second quarter. Now, this was revised downwards from 1.3%, which was a couple of days before that. Early June, they had 1.3%. Now, as of the 7th of June, they have 0.9%. So they're revising their forecast downwards. Do you agree with the notion that A, economic growth is slowing, and B, we could potentially get a recession this year or next year? Keep in mind that most economists' definition of a recession is 2 consecutive quarters of contraction.
By that definition, we're probably could get it. We may get it. I mean, I think 9/10 is positive. I mean, being positive, that's we could miss that recession by definition. But the way I'm looking at it is stock market, prices things in 9 to 12 to 18 months ahead of time. And the market's trading, we're in a recession right now. And because the Fed is tightening during this recessionary, move in the stock market, the dollar's rallying and it's pressuring gold. So I do think that if inflation cools, and because of the trajectory of growth, I think that really opens the door for things like gold to really be able to capitalize in the second half of the year. And by the way, because of moving the dollar, gold may not be performing great this year in dollar terms, but it's performing terrific this year in just about every other currency in the world.
Okay. Yeah, we're gonna come back to gold's performance during prior recessions in just a minute. But last question about recessions: what do you think of the Austrian school of theory of thought, rather, the theory that recessions are caused by asset bubbles? So it goes something like this: you have excess money printing, you have an asset bubble in whatever markets you want to measure it with, and then when the bubble pops, a recession occurs. Is that something that you've noticed? Is that a theory that you concur with based on your real life observations?
Yeah, there's definitely, when asset prices go higher, You're getting, and you get the inflation. I mean, we saw asset prices as in stocks. People were enjoying that. There was excess money. People start spending that excess money, but people were able to save here. I mean, they showed savings during 2021 that people were able to put away. Obviously, now that comes on all that spending still, because people got stimulus checks and whatnot, but all that spending, then created asset inflation, like other inflationary tailwinds too. People now have to pay more. So it all is that sort of domino effect down the road, that when the things pop, people are looking at their stock account, people are looking at their savings account. When things pop, they have less money theoretically because they're spending more. They don't have this money in the stock market this time around, such a recession. So it does trickle through down to that sort of Austrian take on the bubbles popping, leading to recession.
Yes.
And really, again, that's why I think that the stock market is working through recessionary terms right now. If we get a plus 9%, I think it's released later in June here, we get a plus 9% on quarter two, then, I think overall, it's great. It's just a number, but the market and the economy are really working through a recession right now as we're talking. And that's a good thing, because, if you're an investor, you want to get this behind you.
Yeah.
You want to get this behind you. You want to focus on the forward.
Just to clarify, you mean 0.9%, not 9%, right?
Yes, yeah, 0.9%. Yeah, absolutely. I mean,
9%
we're talking China type growth from 2019 or 2018.
Yeah. It's just off topic. Do you think we'll ever see that in the U.S. again? Just random thought.
No, I mean, it really would be tough. I mean, the only way we're going to see that type of growth is look what happened during the pandemic. I mean, you had this lockdown, zero growth, right. and then we're looking at the growth that happens upon such awful conditions. So if this recession, I think this could be this is a minor recession that we're working through, and it's just the proper way of kind of working through, actually what's really there is a better economy, and working through some minor recession within that. But if this gets, say, snowballs into something much worse that I don't really see right now, and then we get a contraction of 5 and 10% GDP, which is would be an awful situation. Then when we bounce back from growth, we can get a 9%, of course. All
right. So let's talk about gold, silver, oil, and stocks performances during prior recessions. And before I ask you, Bill, let me just poll the audience watching right now, write in the comments down below whether or not you think gold, silver, oil, and stocks usually go up or down during a recession. Some of it might be intuitive, some of it might not be, but I'm curious to get the audience's reactions and their thoughts before we get into the actual numbers. Now, but let's start with gold. I just took the last two recessions. I didn't go through all the recessions in the last 100 years, but just the last two, 2008 and then 2001. So the exact dates were March 2001 to November 2001, and then December 2007 to June 2009. So let's start with gold first, and we'll work our way down through the other assets. Gold's performance in 2001, it was up 3% during that 9-month time frame. Between December 2007 to June 2009, so the last Great Recession, it was down 15%. So you got slightly up first recession, down double digits second recession. Granted, those are very different recessions, very different reasons, but can you summarize for us why gold doesn't usually go up or will always go up during a recession? Isn't it supposed to be a safe haven, Bill?
It is supposed to be a safe haven, and I'm curious what gold did. I don't remember the top of my head of that second recession. I think it rallied into that when the recessionary conditions were sort of percolating. And the reason being that during the recession, when you have a stock market crash, and it's to sell everything, sell the baby with the bathwater, raise cash, get your money in cash, and gold doesn't perform in such a deflationary environment. But it's the ensuing policy from there that does make gold and silver, react positively. Yeah. So it's sort of, looking at it now too, where we had the COVID run up, all this money was getting printed. And once the money is getting printed, gold's reacting to that. And then now that it's getting taken away, gold's also reacting to it. But once they stop taking it away, then, gold will perform. And I think that could be something in the second half of the year.
Okay, interesting. Silver is very interesting. So in 2001, remember, Bill, I said that gold went up by 3%. Guess what? Silver went down by 5% in 2001. Now in 2008, gold went down by 15%. Silver was also down by only 4%, 3.5%, 4%. So the first recession, they moved in different directions. Gold went up, silver went down. In the second recession, they both went down. Gold actually more than silver. Now I'm just curious, Bill. I thought silver and gold typically move in the same direction regardless, except it has a higher beta. So whatever gold does, silver just does more. If it goes up more. If it goes down, it goes down more. But that clearly wasn't the case in the last two recessions, right?
Remind me the end of that in the second recession, that last year you're using.
Yeah, 2007, December 2007 to June 2009. So gold went down by 15%. Silver was down by only 3.5%, 3.6 to be exact.
It's hard to remember on the spot, but I do know that, silver did start to really begin to boogie late, it was late 2009. And so maybe it recovered quite a bit of losses, and it had a really record run through 2010. So, that could have been something within those numbers. But on top of it too, I know, silver was also at a very, very beaten down place going into that. So the volatility could have been much lower as well.
All right. Well, just generally speaking, as a trading strategy or philosophy, I know some traders do this. They just look at gold when they trade silver, and then they just apply a higher beta. Is that something you use? You just, as a proxy for the silver price, you look at gold, or are they completely different commodities or assets?
You're right. There's definitely a higher beta to it. I mean, there are other angles to look at. Mm-hmm. We've seen silver move in reaction to the industrial production data, where you do get a component of silver within that data. So there is things that could move silver outside of gold, but for the most part, you're looking at silver as a higher beta play for gold many times, more times than not.
Okay. Well, stocks, no surprise, they went down in both recessions. The second one more severe than 2001 for the S&P 500. In 2001, the S&P was down 8%. In 2008, during the period of 2007 to 2009. It was down 38%. That's pretty self-explanatory. What do you think is going to, let's just speculate. How severe could the next recession be? Is it going to be as bad as 2008? We're going to see a 38% crash in the S&P from current levels?
Well, from current levels, I don't think so. I would really be very surprised. We've already tested down 20% on the year. Right. And I'd like to think there's a low end, but like I said, I don't, the markets don't, if we get a really hot CPI number on Friday, all bets are off. The market can really do anything. And it's in that environment. My take on what we're seeing right here, right now is it's nice to move away over the past 2 weeks from the precipitous selling that took hold in much of April and much of May, meaning buyers are actually showing up and defending the sell-offs. You're starting to see a little bit of shift in momentum, and sentiment is as excessively negative, as it was during the 2008, 2009 period. So, if not more by some measures. So I think that, simple supply demand dynamics, if everyone is already sold, who is left to sell? Now, of course, things could get worse. The Fed could have to get more hawkish, but, from earlier in our conversation. So you got to be an active trader, an active manager, and know what the market you have, not the market that you want. Mr. Market is always right. So staying nimble is the most important thing here in this environment.
Last but not least, crude oil on a list, down both recessions, no surprises there. It was down 3% in 2001. It was down 22% in 2008 during the last recession. Okay, so given that economic growth could slow down, I'm not saying it will, but like I said, the Atlanta Fed's revising down their projections for growth. Are you short oil right now? Should you be short oil? No.
We've been extremely bullish. It's been the gift that keeps on giving for what, going back to, literally 2 years from today almost. This has been something that we've been extremely bullish on. I write research every single day. I don't really remember a day that I've had a bearish bias on crude oil. We put actionable bias out. We remain cautiously bullish right now. We have, just because the volatility just exude to our client base that you got to manage your risk. You can't be just outright bullish on this right now. But just hearing right now, this is a different scenario than we've ever really seen. You have the OPEC Plus or OPEC Secretary General coming out yesterday saying, he's talking about spare capacity is not there. You have the UAE energy minister talking about spare capacity not being there. And this has been the drum that we've been beating since the second half of last year. One of the most bullish narratives around this is the fact that there is no spare capacity. They cannot produce more. And years ago, you go 30, 40 years ago, crude oil only traded on spare capacity. So right now, with no spare capacity, we're heading into a winter that if it is worse and we're not stocking right now through the summer, into the summer season, this is a very bullish situation right now. Again, I think it's very volatile. You can't be unfettered long, but I remain very overweight energy and wealth management portfolios. And I remain a buyer on dips and futures trading.
Well, some people have said, Bill, that $100 a barrel is a key psychological level. It's been breached, and they say that it can't go much higher than that key psychological level. And we are seeing some resistance around that level. But, you're saying you're still bullish. How far can we go?
I guarantee that, you and I had to interview last year at some point. I called for $100 when crude was at 60 or so.
Yes. And,
right now I'm not as confident as I was at that play, but I am fairly confident that I would not be surprised to see $150 crude this year, if not $200 next year.
Excellent. All right, Bill, thank you.
But just buffer that with there's going to be fundamental developments, as things go. You got to take it with a grain of salt. For sure.
I mean, it sounds to me like, Bill, let's suppose we have a recession. I'm not saying we will, but let's suppose we have a slowdown. It doesn't matter how severe it is. Maybe it's mild, maybe it's severe. You're saying that the fundamentals for oil are different than the last two recessions, such that they will be buffered against an economic contraction, lowered demand for oil and whatnot. Is that what's going to happen this time around?
Yeah, oil is going to ultimately be one of the drivers of the recession. It has been, and it's not going to recede. I think unless something fundamentally changes with Europe and Russia and in the Russian oil in general, we're seeing the U.S. bring back Venezuelan oil. That's how desperate they are. We're probably going to see the U.S. encourage Iran oil to come back online. Mm-hmm. So there's desperation here. But there's going to be fundamental developments. There's going to be days where crude's down $10-15. It's going to happen. And but if nothing changes fundamentally from where we are here right now, we're going to see $200 oil, first quarter next year.
All right. Bold call. Thank you so much for making your predictions and giving us your analysis of the markets. Bill, you're welcome to come back anytime. We'll follow up with you soon. Thank you.
Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.